Welcome to the Dividend Talk podcast, episode 211. 4 European dividend stocks with a safe dividend. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. How's your week been?
Really good. Busy at work as always. Also writing and analyzing for the upcoming newsletter. So really nice stock that I picked, I think. Other than that, still enjoying also a little bit of feedback we got based on Lara that joined us on the last podcast. I think it was nice to speak with her. It was refreshing. Someone with a lot of energy, and that was nice. So still a bit earlier on the journey, but also how she was helping her mother and her sister with investing was quite inspiring. We've done more than 200 podcasts, and what stands with me that most often just the regular Joe that comes onto the podcast, if they're not too nervous to talk, they have the best stories because it's so relatable. Yeah, and that's really what I like about this. And it also gives this personal touch here, like how she's a football fan and everything. I really enjoyed it. How about you? How was your week?
Yeah, me too. I'll have to comment on that podcast. I thought it was top class. I know we spoke off air, and Lara, if you're listening, we encourage you to start your own podcast because I think you could definitely inspire a lot of people. And the story was great, especially how she started and when she started and COVID hit. A lot of people would, I know myself, if I got involved around that time, I may have been scared off the market and investing. But Lara had more resilience. So yeah, the story was inspiring and we got a lot of good comments. So I'm glad people enjoyed the show. My week has been the same as always. Work is ramping up. We have major expansions in work, so it's always busy. It just seems to be getting busier and busier. But you know what? I always look forward to the dividends. It takes my mind off work, takes my mind off everything, and we can focus on our passion. So
it's really true, right? We're the core examples of trading time for money. But where at a certain moment this will flip, and where the passive income comes in, so that we can stop trading time for money.
Yeah. But you often say it that especially in the beginning, you've got to do well in work because that's where your increases will go. And look, I'm at that age where you start moving up the ladder if you want to move up because you only have a short window in that period. So you got to be on it and you got to be prepared for that. So
that's you must see it in your savings rate as well then.
Yeah, I see it everywhere. I see it savings rate. I see progression of work. I see it everywhere. I also see it in my workload, unfortunately. But it is good. And from what I was investing maybe 4 years ago, I can invest nearly double that, and that's because of where I work. My base salary is gone up, and I can invest more. So
and you say working more, right? It sounds like sometimes you would say working more hours, but I guess also busier. But my experience is this is usually because the job is new. So
Yeah.
you go through learning curve, are more tired, need to figure out your new routines. But after, let's say, 1.5 to 2 years, that becomes the new baseline, the new routine, and it starts stabilizing again, and the effort that it costs, right?
Yeah.
So there's also this to it, because sometimes I see people that don't want to make this progression because they think like, it's becoming too busy, I will be a workaholic. But this is just usually the learning curve, unless you're in a company that's just rotten. But in many companies, from what I've observed, it's more like, you get more responsibility, more accountability, but it's also because you're inexperienced for that job in the beginning. Yeah.
Yeah.
So once you master that, you learn also more to delegate, all these kinds of things, right? When you grow up in the company, then usually it becomes again like the new normal.
Yeah. Yeah, I agree, and it's something I push for. But hey, let's get back to dividends. Let's not promote our workplaces anymore. And
Yeah, but it relates to the news of the week, because if you really want to have a scalable business, then you can also, of course, and this may be an advice to you, Derek, if you want to get rich quick, start the OnlyFans channel.
I've seen the owner himself. He's an excellent dividend investor. Excellent. He received over 630 million in dividends this year from OnlyFans. I mean,
Unbelievable, right? And this company mainly came into existence because of COVID. I looked at the numbers, and I think before COVID, it was a business, but relatively small, but they exploded during COVID. But honestly, I mean, 630 million, I'm really happy for the owner. But for me, if you ask me today, don't ask me tomorrow, but ask me today, this is the ultimate sin stock. Sometimes you have these things that you're on YouTube and you push the wrong shorts, and then you get sucked into the shorts algorithm, and then you see those, how you say it, those podcasts where an OnlyFans creator is talking, and they all look so stupid, those women. It's unbelievable, like how the view they have in life. They're 18 years old, they're selling themselves to let's call it dirty boys or dirty men, and they get rich with this, and their view on life, it's crazy when you hear it. But imagine that this is maybe in some areas the norm, like that young girls are like 17, 18 years, let's say 18 years, are telling each other like, start an OnlyFans channel because you will earn money and you can afford a nice house or something like that. But for me, I mean, I have a daughter. I mean, for me, I would be like Liam Neeson if I would ever see my daughter having an account there, and somewhere. I will strike her down, and I will roll up this whole company myself.
yeah,
I mean, it's for me, it's the ultimate sin stock. I could never, even if it would ever be tradable, because I think they wanted to do an IPO a while ago, but then they didn't want to have the sex workers on there. I think that's when nobody wanted to buy the IPO anymore.
yeah,
But
yeah,
I could never own it. I could
yeah.
never own it.
I think, to be fair, that the owner and those involved are keen to stress that it's not only that side. Now, obviously, that side exists, and that's what it's famous for. That's what everybody knows it for. But you've also got music, yoga, and all these. But I can't imagine many people are signing up for those. I look at the revenue that it paid to its content creators, over 6.6 billion, which seems like a lot, but there's 4.1 million users or creators on this account. So if it was spread evenly, which we know it's not, there's some people making nothing, some people making obviously a lot, but that only equates to around 1,400 a content creator, which is not a lot considering the type of content that they are putting out there. So yeah, I agree with you. It just has that name as being a porn streamer, and I don't think it will escape that, unfortunately. And ultimate sin stock, yes, definitely.
Yeah.
Definitely.
Anyway, I'm already getting frustrated. Let's. Do we have some better news?
Do you know what? I didn't have news this week, but I did have a question. I had a question for you, and I posted this in one of our groups. I can't remember which one. Maybe Facebook, Twitter. I can't remember. But I saw something, or something was posted about Reddit. Actually, one of our members, Enzo, sent it to me on Twitter, and it was around estate taxes in the US. Some poor family, the father has passed away. So there was an inheritance there. There was over 300K in the account. It was like a Links, I think it's an Interactive Brokers kind of account, right? So they went and tried and withdraw the money. Interactive Brokers said, no, you're not withdrawing this money. We're holding this money. There's estate taxes due. And they went and got advice from a financial legal person. They said, wait, blah, blah, blah. And it turns out they got fined for being late filing taxes. They're struggling to get the money out. And it's like really, really hard for them to get access to that money. So, it's a stressful enough time losing their parent or their husband and then trying to get this money out and they can't, right? So my question to you is, because we got asked this question before, and I think going back on it, we said that we don't know if Europeans will enforce this. But the problem is we both have Interactive Brokers account,
which is an American company.
Well,
it has also a UK legal entity, and I think they're switching now. The legal entity are rolling it up in Europe. But yeah, it's a good question. I think so. You know what? We know that this estate tax exists, right? And it's good that you bring this also to our attention, or the listener. I think everyone should check with their broker what happens in such case. I think this is not information I said we should take we should do here, because I'm not a legal advisor. I do really not generally worry about it. Yeah. But seeing this case does make me think twice. Are times changing? Yeah. So, for instance, I will need to ask this question to the hero and to Interactive Brokers, like, hey, what happens in the, because, for instance, I believe when I read the case also that there is still someone else living there, because I've got a second person signed up. I've got, I believe, a joint account at Interactive Brokers. So it will be more the case if we both pass away quickly. But still, what happens in that case? I think this requires just a fiscal advisor and a message to your broker and getting it black and white.
Yeah. And it seems even on advice, these guys were struggling as well. So it mightn't be as clear cut.
Yeah, exactly.
As we like. But when I seen that, it triggered me a little bit. It is kind of scary on two parts. One, that we don't fully understand the risks. And two, it is probably hard to get an answer in black and white, like you were saying.
And three, that there's a foreign government intervening with our local tax rules, and just harvesting money away. It's even worse.
Yeah. So it long story short, for me, it does worry me a little bit. I'm not a financial expert. I'm not an expert in legal matters, but the fact that this has happened and can happen, especially with Interactive Brokers, which I would consider my main account,
me too,
is a worry. So I'll probably reach out to Interactive Brokers myself and ask the question.
I think everyone should do that.
And see what they say. But it's definitely worrying. Definitely a worrying situation.
Yeah.
More positive news. Let's look at some dividend hikes. I have 3 or 4 that I can note. The first one is one of my favorites. VICI Properties increased their dividend by 4%. It's the lowest dividend increase they've had, but they start with a 5% dividend yield. So I mean, 4% is not too bad at all. Brady Corporation, which is a company that does safety shoes and workwear and all this kind of clothing. I think they have a 39-year dividend history, and I've never heard of them before this week. And they had an increase of 2.1% to 24-cent quarterly. Broadcom increased their dividend by 1%, which I think is disappointing by their standards.
Hallelujah. How is that possible?
I don't know. And I seen they've dipped. I've seen that on Twitter. They must have been down 8 or 9% as well. So some bad news must have coming out. But we know that's
a cyclical business, right? Maybe this is just the smartest thing to do.
Yeah, of course. Look, if when they're doing well, they'll reward you well, and if they're not, why be silly? And then Verizon increased it by 1.9%. And look, they're a high yield, or 6.2%. So low dividend increases are to be expected. So the topic was 4 European dividend stocks with a safe dividend. And obviously, this was inspired by our previous conversation around US estate taxes. Why do we even need US companies when we got such strong companies in Europe? We'll give four examples. I'll note that we took inspiration from our own dashboard and we used our dividend safety rating to pick these. It's not in order of dividend safety, and actually they're not even the highest dividend safeties that are out there, but they are 4 businesses that we believe have a fair or safe dividend. So I might start, and it's a company I might have mentioned once on the show, but it is Man and Machine in English. In German, it is Munch und Maschine. I don't know if I pronounced that very well, so apologies to my German friends.
Ich denke, dass es heißt Mensch und Maschine.
Okay, nice. You said it way better than me. Ticker symbol is MUM, and it's on, obviously, the German Stock Exchange. So, I remember a while back we were talking about Autodesk, and they come up and we were looking into them a little bit. Well, Man and Machine, I'm going to stick to the English version, right? Because it's easier for me. But they are known for their partnership with Autodesk. Basically, for the 30 years, they were an Autodesk reseller. It was probably 80-90% of their business. So it's like affiliate marketing for all the world. They sold Autodesk products in Europe. They gave customer support. If you had a technical question, you could go to them, and a really good relationship, because Europe and US, there's this time difference, and it's when you're working in a company, you need an answer now or not in 8 or 5 hours time. So it worked really well. But over time, especially over the last decade, they've started to switch away from Autodesk. And what Autodesk do, for those that don't know, is they make software like computer-aided designs. So you see all these like designs on your computer for buildings, machines. Basically, this software can do that. So they sell that. They then start to develop their own software that can integrate with this. So more computer-aided manufacturing, BIM software. So they start developing this software. It's not a direct competitor of Autodesk. It actually complements what Autodesk does. And this is where the magic is for this company. The gross margins on this software side of the business, what would you say they are? 90%. 90%. Like, that is crazy. 90% gross margin. Whereas you look at the other side, where it's a reseller of Autodesk, you're looking at gross margins of around 30%. So wow. you can see where the magic is with this company already. The profitability is through the roof. The sales is increasing. I think it was 11% CAGR over the last 5 or 6 years. So the growth is incredible. So I think that's where the golden nugget is of this company. And they still have the Autodesk reseller business there, which kind of stabilizes the business, gives it a good base. But the fact that they're not reliant on it anymore is the real golden nugget with this company. So I think it's really worth looking into them, particularly as a software company that has a strong, like, everywhere I've seen, every single workplace I've been in, colleges, I've always seen Autodesk and CAD everywhere. I don't think I've seen any other competitor. There probably is one out there, but I've never been in a company or seen a company that has it's that strong, it's that good of a product. And then the fact that these guys have these softwares that can go in and link with these makes it like a really, really, really strong business model. We talk about the dividend history. I have to note 2 things. One, they have cut the dividend in the past. They've cut it twice, which is not ideal. But when I go back and I look at when they cut the dividend, and I look at the communications in 2 or 3 quarters leading up to the dividend cut, management have been very, very clear in terms of what's happening, that what's expected. They don't outright say there's a dividend cut coming, but they basically tell you in words, we're struggling this year. Our goals are to remain below 3 times EBITDA. We're not going to reach that if the dividend is this. And they basically tell you we're going to cut the dividend. So they're giving you a fair chance. to get out if you want. And then when they're going through non-cyclical times, the growth is pretty strong. So I kind of give them a pass on that, because you have a kind of heads up beforehand, but it's something to be aware of. They can cut the dividend, as we know European companies do, with differing dividend policies. In terms of our balance sheet, it's quite strong. Their debt, they have been reducing it quite aggressively since 2015. It was almost non-existent in 2023. They reduced it. So they've been pretty much focusing on shoring up that balance sheet, and I think they do have a strong balance sheet now. Yeah, so look, overall, I think it's good company in terms of its products. I think the software side is the crown jewel. Strong market. I think growth will always be there, particularly in computer-aided drawings and that kind of market. Every business I know use that, and they've changed that business model as well, Autodesk, haven't they? That it's not perpetual, it's recurring licenses.
Yeah, the SaaS model.
Yeah, and once you're in that, you don't come away from that, and obviously these guys benefit from that as well. A strong balance sheet. I would say a good dividend history, apart from the cuts, but the last 10 years it's been pretty solid.
They had the last 5-year CAGR of almost 15%, 14%, I believe.
Yeah, but they've been growing really well. So when Autodesk changed their policy to go from perpetual to a SaaS model, there was a 2 or 3 year kind of bedding in period, and we saw people dropping off and coming in. Once that has stabilized down, the revenue started to ramp up, earnings have started to ramp up, and they do reward shareholders with big increases once it stabilizes. So,
and do you see them long term more and more getting disconnected from that, from the dependency on Autodesk? I believe you mentioned.
Yeah. So it is less than 30%, I believe. I have to check the exact figure. I wrote about these guys, and there's a chart that shows that, so I don't have it to hand, but it used to be 90%. It's now around 30%. So they have decreased. I would imagine they'll stabilize around 20%. I don't think they'll get rid of it altogether, because they do complement Autodesk, and I think it's important to have that relationship. It gives them access to probably information that we don't have, and new features, and they can integrate that into their software a lot more easier. So I think around 20 or 30% reliance on Autodesk is probably fine for them. It stabilizes revenue for them as well, particularly with that SaaS model.
Yeah, nice. Well, I think it's a really nice company, and one that is almost never spoken about on social media or anywhere, right? So, and clearly, if you look at the numbers, it seems to be a pretty solid company that a good run up over the last few years. Question is how it will do in times of headwinds, because if it's like, if we're talking like AutoCAD and such, we're really talking about software that is being used in the industrial sector, software that's being used in the real estate sector, software that's being used in the oil and gas, in the energy sector, and many of those sectors are cyclical. Yeah. So the moment maybe large capital projects are cancelled, are stopped, it's the moment where they also can easily switch off the SaaS model. Yeah. So there is a sensitivity to that, and we have seen 10 years of a golden decade. I believe we may not see such a decade of growth in our lifetime again, as we have seen with going from high interest rates to zero in the aftermath of 2008. Yeah. So maybe the AI evolution will do something to that again, but that's still yet to be seen. So yeah, this company has been riding the wave quite clearly on that as well. Yeah. So that's the biggest risk I see. If we get in a prolonged downturn, let's say, and maybe a flat stock market over the next decade, companies being, because companies have been leveraging up, they will need to unwind debt from the balance sheet as well at a certain moment. So yeah, then I'm wondering how such a company performs, and then you will see also like their resilience during such times.
Exactly.
But this applies to many companies, not just to mention machine, of course.
The only thing I'll say there is they've been looking after their balance sheet. They've been leveraging down, getting rid of that debt, which I actually like.
Yes, the debt is really low.
Yeah. So if they have a prolonged period, it might struggle, but I think they could navigate a short and medium term.
Yeah, and they have enough free cash flow to cover the dividends as such as well.
Yeah.
Good one. I mean, it's very interesting company, I would say, and yeah, nice one that you chose it.
Yeah.
So yeah, let's stay in Germany then for a while before we go to other countries in Europe, because last week we had Lara on the show and I kind of recommended her to have a look into Hornbach. So I'm a bit biased there, I must say. With Hornbach, I lived in the Netherlands near the German border, and when I was in my early 20s, I guess, as a student, I had to fix something in my apartment or my room. Then I would typically go to the Hornbach to buy my first drill. Just simple thing, yeah. And when you walked into Hornbach, you need to think that you come in such a really giant do-it-yourself store, which always feels like it's for real men. Yeah, man with a beard, man that eat a sausage straight from the bonfire. Yeah, that's kind of the experience that it gave me. Also, they had really great commercials, like just really, jumping on this brand of manhood. Yeah, let's say of this reputation. So, fun fact is they actually started already in 1877. So this company exists for almost 150 years. They started, the Hornbach family started with this in Landau Pfalz, and they really started simple. But of course, over the years, they started to reinvent themselves, specifically in the after the Second World War. But what is really interesting is that until today, it's still a family-led business. Yeah, so it's always been passed on to the next one in line, to the sons. So we'll see who the next successor is. I'm not sure who that is, but they have at the moment 171 do-it-yourself stores in Europe. The majority in Germany, 98 of that, 18 in the Netherlands. But for instance, they have also 10 in Czech Republic, 8 in Sweden, 9 in Romania, 14 in Austria, 8 in Switzerland, and 1 in Luxembourg. So it is really centered around the center of Europe, I would say. Unfortunately, they are not in Poland, which I find a pity. They are not in my proximity. It was good to know that structurally wise Hornbach is split up a little bit in Hornbach Baumarkt, but they have also Hornbach Immobilien, Bauhof. So they have a bit of a relatively complicated legal structure, but in the end, it comes down to it that the Hornbach family owns 37.5% of the company, and other people 62.5%. So, which I think is even good, because the fact that the company is where it is today is, I believe, because it's a family business. It is a slow growing business from that point of view, a stable growing business. But, we know that founder-led businesses and family businesses, they usually look at it from a marathon point of view and seem to outperform other companies or outlive other companies in their markets. Yeah. What for me is very interesting statistic, and this is where I went wrong a little bit last time. But Hornbach makes the most sales per square meter. Yeah, the most sales per square meter, and that's also very interesting statistic for me, in Europe at least, because I believe Home Depot does it better in the States. But overall, they make the most sales per square meter, and more than Bauhaus or Kingfisher. So that's also very interesting. And we're talking here maybe about Germany. So for me, if I look at this company, it really, of course, got a strong boost during COVID. Many people started to repair things and everything. And since then, it has been a little bit flat. Cash flow continues to grow. Free cash flow looks really good, but there are some one-offs in there that I think we need to account for. So overall, the company has been a little bit, let's say, bottom line, a bit stagnating in the last 2 years, and they haven't really opened a lot of new stores either. So store count is not really contributing to the growth, mostly organic growth for now. So it will be interesting to see, like, what are the plans going forward when it comes to store count. There are some plans, but there hasn't been really, at least since I checked, a very clear articulation of the company here. Dividend wise, it has been it is kind of as a staircase. So it has already 3 years of a flat dividend, but it had also flat dividends for 5 years before. But then suddenly they bump it really large, right? Because the company has a 30% dividend payout ratio, and that's very low. Yeah. So, but which means if you get the company for a 3% yield, is that you're making a 10% free cash flow yield, and this is of course very attractive, right? Because the 7% of the cash flow that's left can be, in their case, used for other things like store openings, investments, buybacks if they wanted to. So this company is typically trading at a very attractive cash flow yield. And yeah, the company is just very conservative. That's why they don't necessarily cut the dividend, because their policy is also flat dividend if it goes, let's say, above 30%, but they just build in this margin of safety in their business, which I prefer. And if you think from a portfolio point of view, I wouldn't like every stock in my portfolio to be like this, but to blend in a little bit, I'm okay with that. So generally speaking, if you even consider the last 3 years being a flat dividend, their 5-year CAGR is around 10% at the moment, and the stock yields slightly above 3%, and they have a dividend growth track record of 30 years. And I think the 30% dividend payout ratio and kind of sticking to that, plus the stability of the business, is what, in my opinion, makes this a safe dividend here, and one that I think people could look into. It is not the shiny tower of some companies that hike dividends by 10%. If you think about Home Depot or something like that, the growth that they've been seeing, Hornbach has not been demonstrating that over the last few years. But if you want to own a European do-it-yourself store that most of our listeners will be more familiar with based on the locations that they are, I think have a look at it and see if you see to what conclusion you come.
Yeah, it's a nice company. Like family-owned businesses, as you said, generally tend to outperform, and it's good.
At least outlive their competitors, right? Yeah. Maybe not outperform on the short term when we talk about 10 years, but when you zoom out to 30 years, then it becomes a different story.
You mentioned last week that you reached out to investor relations. Did that happen?
Well, I might not have shown up. I need to check when the meeting is.
that shows how busy I am. I was keen to know if they got back to you. But I think with most European companies that have a dividend policy that's linked to a payout ratio compared to earnings, you can't expect growth every year. You can't expect it. You'd have to incorporate a couple of years of flat dividend growth. So it doesn't bother me once the long-term trajectory is up. But nice company. I read your article as well, very well written, and inspired me as well. So nice article. Let's move away from Germany then a little bit. We can't have Germany taking all our good European companies.
Yeah, but please don't go too far away.
Okay, I'll try not to. I went to Denmark, and the company that I have is Carlsberg. Now, you know, I'm an Irishman. I like my drink. You would have expected Diageo to be here. But when it comes to dividend safety, they're not actually too far apart, both of them. But I think I'd prefer Carlsberg over Diageo at the moment. Carlsberg is the third largest brewery in the world, behind obviously Budweiser and our very own Heineken as well. So you expect them to be the top two. Carlsberg is third. Now, when I say it's third, it is a lot behind those two, but it's still comfortably in third place. For those that don't know the company that well, I recommend going and reading about their history. They have lots of resources on their website around their history. It's actually a very, very interesting history that they have. To give you kind of a short synopsis, it was set up by J.C. Jacobsen in 1847. He was well known at the time, well-known investor, well-known personality. Built the company up to a certain level. His son was meant to take over the company. He was manager. They ended up fighting. They split the company, so there was two different Carlsbergs. The son's company was exporting all around the world. The father's company was not. Before the father passed away, they ended up making up their differences. And it took a couple of years then, and they rejoined into what we know as Carlsberg today. But it's a really, really interesting story about how it came about. And yeah, I definitely recommend going and reading it. J.C. Jacobson was kind of an interesting man. For example, the logos, you know what the logos are? The two elephants. So they were picked because it symbolizes loyalty and strength. And I kind of had a laugh at that when I was reading the story about their son divided the company, but that's what the elephants symbolize. He also set up the Carlsberg Research Laboratory, and that's still going today. It's one of the biggest research laboratories in the world, and it was set up with a mission. And the mission, they have what they call, it's inscribed on these golden gates, and it says, in work in the brewery, it should be a constant purpose, regardless of immediate gain, to develop the art of making beer to the greatest possible degree of perfection, so that this brewery, as well as its products, may stand out as a model, and through their example, assist in keeping the brewery in this country at a high and honorable level.
I would love to speak to a factory worker that's putting the bottles in a box and tell this to them and think, listen to what they have to say.
They don't care about that, but I would love to speak.
This is the biggest bullshit ever.
It may be, but at the time he may have believed this. Like, and
okay, at the time maybe, yeah. But okay, sorry, I'll take back my words. But today,
but you think in 1847?
No, you're right. You're right. That must have been.
In 2024, we're going to have these big factories where people are paid
low
amounts
of
money.
You're right. You're right. Yeah.
But like he set up a research center just for this purpose, and it's still there. And yeah, I think it's incredible at that time to be thinking about these things.
True. So. This is what you call the modern day beer lover.
yes. And his search for that beer, I think they go for like a darker beer.
Yeah.
Carlsberg is up there in the world. And I think the difference with the son is the son went to Bavaria, so the son traveled a lot. We know Bavarian beer is kind of light in Germany, and the son wanted to use those recipes, and they had a big falling out over that. But in the end, what's happening now is they have a company that has both, and it worked.
Nice.
It worked out in the end. But look, they sell beer, and as we know, there's only so much you can increase prices of beer, so they have to use different tactics to try and increase their competitiveness in the market, particularly when you have two juggernauts like Budweiser and Heineken in the markets. They're trying to do this by what they call these premium beers. So they have these premium beers that they sell at a premium, obviously, and it drives most of the revenue. And then they have two other tiers, which are like local beers and then not so popular beers, which all made in the same brewery, mind you, but they're charged at slightly less prices. They've also recently bought Britvic. I don't know if you remember having that in the news. And Britvic is like a soft drinks supplier, so not alcohol. And they're using that to like diversify into that, because I think one of the things with beers, as we get more westernized, or I don't know, how would you say it, educated, health comes into it, and the consumption of beer is starting to decrease. And I can see that in kids in Ireland. Typically when we were growing up, there was a lot more people out drinking and socializing in pubs. Not so much anymore, and it's getting less and less and less. And I see that with my sons. They don't even eat sugar as much, so they're starting to be more health conscious based on what's around that. So Carlsberg are taking a little bit of initiative and moving into a market with Britvic, which was a UK company. They have brands like Robinson's Tango. I don't know if you have that on the continent, but they also have a relationship with Pepsi Max. And Carlsberg were already a reseller of Pepsi products in Europe, and now this strengthens that. So if you want a bit of exposure to Pepsi, but you don't want to own Pepsi because their payout ratio is through the roof, and you're frightened they might cut their dividend, Carlsberg gives you a bit of European exposure to that. So I think that's a very, very good acquisition for them, if I'm honest.
Yeah.
It didn't impact the balance sheet massively. The balance sheet is still quite strong. One of their goals is They have three main goals, but their goals are to maintain a balance sheet with a net interest debt bearing to EBITDA below 2x. I think it's around 2.9 now after the acquisition. They maintain a payout ratio of around 50%, and they're targeting organic growth rates of around 3 to 5%. And this was all encompassed in their investor day where they had this sale 27. So this is their plan up until 2027. Went back on their previous two investor days. So they had sale 21, I think.
Yeah.
Or 23 and sale 17 or 18. And similar kind of, I would say, goals, but they've always exceeded their target. Every single time they've always exceeded their target. And they started the first 2 years exceeding their target as well on this in terms of increase in dividends at double digits and share buybacks over the last 3 years has been incredible. So they're generating a large amount of cash flow and returning that to shareholders, which I really like. This policy came into effect. Its 50% payout ratio came into effect in 2016. And as you can see, since 2016, they've grown their dividend at a CAGR of around 10, 11%. So it's quite strong in terms of dividends. Earnings and free cash flow growth are growing in tandem with that. So they're paying from cash flow. Their debt level was around 21 billion. That might have risen a small bit since the acquisition of Britvic. But yeah, I think it's a solid company. More than Heineken, I would say, in terms of dividend safety, dividend consistency. We know Heineken does special dividends, but it's prone to cut its dividends. So if you're looking for something in the brewery space, you like a drink, you like a tipple, I think Carlsberg is a solid option.
Nice one. Yeah, I mean, definitely there's also a much better track record than Heineken, which is also a family-owned business. Yeah, so at least in this case, Carlsberg does much better. I mean, I'm not such a big fan of beer, so that's why I don't have the same passion as you do talking about such companies. But I think, in this case, it's often with these stocks, right? Numbers speak more than 1,000 words and opinions. Yeah, in the end, the three financial statements, most often of the times when you look at it over the last 5-6 years, they tell the real story. Yeah, I know it's a bit still like not the future story, so it can be still misleading, but nice pick. And at least for all the people drinking Carlsberg, know that if you would own it, some of it goes as a cashback back to your own pocket.
Yeah, exactly. You're rewarding yourself in both happiness and money.
Yeah, maybe the youth doesn't understand that yet.
Yeah. The only problem with Carlsberg is they're not in America. They haven't, and they won't break that market. And Budweiser obviously has that market, so they're going to compete in the other markets. But America is such a huge market not to be in, which is why Budweiser might be a better. It's not Budweiser. I can't remember the name. AUD. But yeah, Budweiser are much bigger for that reason.
Yeah, it is interesting, right? What you said about health conscious youth, which by the way is very good in my opinion, because I've seen too many alcoholics in my life around me. And then we were also talking about Diageo the other day, right?
Yeah.
So if you look at these companies, I don't know if it's temporarily, because there was also a time a few years ago that McDonald's, suddenly nobody was going to McDonald's anymore because it was trash and not healthy. They introduced this chef burger or something like that, and 5 years later, company double profits and everything, or something like that. So, I mean, the question always is this like a secular trend, or is it just like a phase influenced maybe by a few celebrities that get its own narrative, and 2-3 years from now they go to a beer fest, Oktoberfest in Germany, and we're back to where we were.
I always think you hear the saying that hard times make soft men and soft men make hard times, and I feel like that we are in the soft men stage, and hard times are coming. But I believe like when you're in those hard times, they might not be able to afford avocado and eggs on toast. So they might end up having one or two more drinks. So I think it could be cyclical, and we also have emerging markets that come out of being emerging markets and start to progress, similar to what Europe did, and they might start consuming more the premium brands and so that I think there is scope throughout the world. I would say it's cyclical, but it's probably long cycles rather than short cycles. So let's see.
Makes sense. Well, hey, nice pick. Then let me also then talk about the fourth stock and the last stock of the four that we were doing. And I think this one is not new to people, but I haven't really spoken about that a lot because on episode 186 we had the Wolf of Hardcore Street with us, who did a really deep dive on evolution. So if people have heard that already and are not so interested in my opinion, just fast forward 5 minutes here on the podcast now. But I believe that Wolf also did a really good story about this deep dive, although there's, of course, some stuff going on with this company as well at the moment. So for people that don't know what Evolution AB is and they don't want to listen to a full episode 186 here, then stay with me. So it's a Swedish gaming company. Think about games here in the terms of casinos. So they have two lines of business. They do live casino. If you've never seen it, check on YouTube. It's very interesting. It's literally like if you're in a casino, but then from behind your screen. But live here means that there's a real person doing the roulette or something like that. Yeah, on a live streaming, live video, let's say. And then they have also this, I think they call it RNG, which is the minority of their business. It's probably 15%, which means like random number generator games. Those are those slot machines that you know from the casinos. And that's also what they offer digitally. It's a company from Sweden, and it's been growing quite fast. So for actually, if you would go to the bucket of growth stocks, Evolution Gaming will be found in there because they have been doubling their business, I think, each third year or something like that, fourth year. Let's maybe not say over the last 2 years, but they've been growing really, really rapidly. Now, why are they on our radar actually? Because they have a dividend policy of 50% of their, what they say, consolidated net profit. Now you can imagine if you have a fast growing company that this dividend has also been fast growing. They have a 5-year CAGR of 65%. Yeah, and the company actually has a dividend yield at the moment of 2.75%. So if they've been doubling the dividend every 2 years, yeah, then who knows where this dividend will be in the next 2 years, right? But that's again, I'll come to that soon. That's a case of the future. Now, if I look really at why this company has a lot of potential for growth ahead, it is like it's entering America at the moment. Yeah, you get more and more news updates about this state is legalizing online gaming, online casinos, the other state. And Evolution AB has just simply, from what I've seen, what I've analyzed, and what I hear, what I read in the reports, the best setup for live gaming and the best experience to the people, to the gamblers, let's say. So there's still so much room for them to grow, as online gaming is not yet penetrated everywhere in the world, not yet legalized everywhere in the world. So there's still a long path ahead of them, I think, based on that single. Now the question, of course, is like, how will governments stay being so leading into this, right? The other question is, of course, how they deal. Can they scale? Yeah, because one of the issues at the moment that I really think is a risk to the company, you may have read it, Evolution Gaming in Georgia, they have more than 4,000 workers there, mostly by Georgian students. They went on the strike in July, demanding a pay raise and proper working conditions. So while the company, Evolution, says that they're actually doing a good job, yeah, in their eyes, the students definitely say, no, you're just painting the grass green. So, for instance, they're complaining that they don't get enough breaks during the shifts. that there are obstacles to paid and unpaid leave, and that there's not a safe and decent enough working environment. And this is not good when you have employees going on a strike and such. Also, if you look at the salaries that they have, they earn around $329 net per month, or $450 if you do night shifts. I don't know if that's a fair salary in Georgia. I can't judge, but clearly they challenge this, and that they say that the reality is way more grim, and that they rather make less, and that bonuses are a big part of that monthly salary. So, but they could also easily be lost, for instance, if they are getting sick. Yeah, so it seems to be that the students don't feel that these are proper conditions, and this can hurt the business in the long term. Yeah, so the company needs to figure this out. And why I'm saying this, if you look at the cash flow of the company, they have been hiring a lot of people to help scaling the business. It's similar to what Achen was doing. Achen at a certain moment last year, they invested a lot in hiring developers. It hit their cash flow short term, but with long-term view in mind. This is what they are doing as well. But if, for instance, they end up hiking the salaries and putting better conditions in place, that means that the overall operations of the business also becomes more expensive. Yeah, and I think always you need to pay your workers well. Yeah, because it will outlast, it will do better, more motivation to your people in the company, and it should bring up the revenue faster as well. So, but this I think is one of the biggest risks I see with a company like Evolution. Are they able to scale? Yeah, and this is not helping these strikes. If you just look at the last quarterly earnings, the company continues to grow. I said they are 15% in revenues more than the same period, second quarter last year. Earnings per share, however, were hardly growing to a 3%, but this has to do with the higher cost that they are having now. And all in all, I think it's a solid company, having had really high growth. Growth is slowing down. So I don't think that the dividend will double again over the next 2 years. I think that's not reliable or to expect. And I think also that the dividend yield of 2.7% also reflects that and takes that into account. So all in all, it's I own some Evolution, solid company. It's not for the light-hearted people, I would say. It is also very much a sin stock, I would argue, in the category of tobacco and maybe OnlyFans and such. So that's also something to take into consideration. I think this will always therefore suppress the multiple. So if you think that it will give multiples like Nvidia or something like that, I don't see that happening because of the sin stock category. But about sin stocks, for one it is a sin stock, for other one not. So there's always a market for it.
Yeah. And you'd have to feel sorry for those workers in Georgia. It seems like that they're underpaid and understaffed. I know they're hiring a lot, but that's the message I'm getting there. So you wonder, even though they're hiring a lot of people, are they allocating them to the right places, or are they opening up multiple branches with short staff in each branch just to get the most out of them? I don't know if you've ever tried this online gambling, but man, that job must be incredibly tough. You're standing there in front of a camera, you don't see anybody, and you're dealing cards or spinning for, I'm sure they do 8-hour shifts. It must be torture.
Yeah. But hey, as a student, we all had shitty jobs.
Yeah, you have to do it. But interesting company. You look forward to seeing what the growth is over the next few years. But America is the key.
America's the key, yeah. And that's why I think they need to fix this workers issue. They really need to do something about the worker experience. Maybe they just need to have a live audience, even if it's fake, like what you saw in those television shows in the past.
Yeah. So there you have it, 4 European dividend stocks. Couple of sin stocks, a couple from Germany. So a wide range, but honestly, I think all 4 have relatively safe, definitely in the short term. Dividends, and I like all 4.
We got like 20 questions. Yes, we go
Yes.
to the listeners' question section. I knew you were about to say that. Let's try to do it in a rapid way, which is still slow for us. Yeah.
Yeah, every time you say that, it's slower.
Yeah. Okay. So let's
It's slow.
now like be concise.
Yeah,
Full stop.
Okay. Yoval asked us 2 episodes ago, you talked about the industrials and materials sectors. And we said we probably would not hold them near retirement. Why is that?
Oh boy, this will be a long answer. No, I'll try to do it short. Simply said, those sectors are too cyclical. So when I talk about materials, it's like I've got BHP here, and now having it just for the high dividend, but it's irregular. I think I may want more stable dividends at that time. When I think about industrials, I'm not talking about Siemens, because Siemens is kind of able to manage through the cycle. But I'm more thinking around something like BASF or something like that. Yeah,
Yeah.
not really. I don't feel the dividend is safe enough for me in retirement, and I would even put more attention to safety. So the question is, why own it now? Actually, that's a very good question, and I'm considering like shouldn't I just shell BASF as an example?
Yeah. But I think I agree with you. I don't think we did say we wouldn't have those sectors, but there's always special cases. And you mentioned
Yes,
Siemens. So it's not
Siemens.
that
Yeah.
you won't hold any companies in those, but definitely the cyclical companies would be excluded.
Yeah, exactly. And sometimes they sneak into my portfolio now. But those are typically sectors that I have anyway already a very low allocation to in my entire portfolio.
Yep. Jan has said 2 weeks ago we were talking about pensions, and we both mentioned we would not rely on any state pensions at all. Um, given that we are thinking like this, would the state be in trouble if more people start to think like this and don't invest in pensions? And do you fear then that they would tax your dividends much higher?
Yes, I do think that if I see the trend in society, and specifically people on the left, sorry to make this political, that are thinking that wealth is unfair and it's not equally distributed and such, they have a large vote in society, so they will vote on politicians that come with this insane kind of thinking that we should tax the wealthy, not taking into account like, well, they have been spending like madmen going into debt, and I've been living a, let's say, a frugal enough life, thinking about the future, and then coming to harvest all my wealth back into the tax system. I do fear for that. And the question then is also, do I prepare for such an event? I don't prepare for it, but if it happens and I feel I'm screwed, I'm the first one probably leaving the country and going to a better place. Now, what is the right level of taxation? I think it depends on context and alternatives at that moment in time.
Yeah, it's tough. It's tough to prepare for such event, but given the rhetoric in the world at the moment, we've already seen in America talking about taxing unrealized gains. I mean, it's not too far fetched
Yeah,
to think
but
that.
you know what's the irony? People think that being wealthy is unfair and that we are privileged or something like that. But the irony of it is that most of the people like that build wealth, like the let's say they're just millionaires, something like that, they have sacrificed a lot for getting there, while the others were just watching, I don't know, Jerry Springer or something like that every afternoon. We were hustling, we were working, we were studying to make better of our life, right? So it is quite an irony when you think about it, and this frustrates me sometimes. Not there. I mean, yes, there will be people that are born into wealth and maybe are making bad commercial, but the majority is just smart with their money and work hard for it. Yeah, and yeah,
Yeah. Next question. I can see you. I can see you getting frustrated.
yeah.
Dividend fill. I'm in the early accumulation phase. Every dividend I get is reinvested into positions that are in the red. He's noticing that this is throwing off his sector allocations. Would you worry about it at this stage, or just carry on buying what's cheap?
I think dividend, Phil. I think you need to start disconnecting from the price in the stock market. because I think you'll end up what we had sometimes, that you start investing in turnarounds, because if the market is general green and you start looking at red days, you end up quickly in turnarounds. I really think you need to disconnect more and more the price, which is not easy, but I've been training my muscle on this, and just look at, is the company at a certain moment in time, is it just the right time to buy? Would you pay for it? If you know that the price will be up 2 weeks from now by 5 or 10%, would you regret buying it today? I would look at it like that, because the red days is really informed mostly by price and thinking that it's cheaper then. But I've not benefited from such an investment style.
Yeah, and just to answer the other part of the question, I felt like that in the beginning as well. I had a sector allocation that I thought I had to stick to, and I was trying to stick to it a lot in the beginning and have them at my ideal, say, allocations. But what I found is that I was not always buying what was right. Sometimes I was buying something that was overvalued because I was evening up my sector allocation. So I think once you're in the accumulation phase, it doesn't matter. Buy what you think. I don't like the word cheap. Buy what you think is undervalued at the time, and don't worry about sector allocation. As you get towards retirement, you can start to even that out a bit. But I think
because sectors are at different periods in time,
exactly
showing different valuation.
It will even itself over time. So during the accumulation phase, I would not worry too much about sector allocation.
But I would ask I would ask yourself, like, how much do you want to own eventually in a certain sector? Do you want to have most in information technology stocks and consumer staples, or most in industrials and materials? I would spend some time thinking about that, because then at least you can also gear your watch list around it.
Philippe has asked, what do you do with small positions in your portfolio that started as a few shares of initial position and now have a low yield because they appreciated in price by a lot? Would you keep the winner or sell and put the money to work elsewhere in higher yielding stocks?
So I learned to keep your winners run and not sell your winners and redeploy the money in losers.
Yeah, I've learned that too. So you've got two people who've learned that, so you can learn from our mistakes, Philip. I would not sell them for the sake of it. I would not sell them for the sake of it just to buy a higher yielding, because you could be buying a worse company.
I have been thinking about selling Microsoft. So I bought them the first time at around $42. I've been thinking about selling them at 60, 80, 120, 180, 220, 280, 300, and even now at 400. This sometimes pops up in my mind. The dividend underlying has been growing by 10% each year or something like that. So actually my dividend income has been, it's one of the best performers in dividend income. But yeah, just don't look at the price. I know that there's this thinking like, if it's 1% yield now, I can sell the whole bunch. Well, first of all, I have a lot of capital gain stacks on it. But okay, let's take that out of the equation. Yeah, I could triple my dividend income at once. That's true. But yeah, no, I don't sell my winners anymore.
Yoram has said that he tries to buy at red days and when the price dips. For this purpose, do you keep cash available on the sidelines? And if so, which percentage of your portfolio?
No, I had it in the past, like this typical war chest. I don't have it anymore. I was always thinking a crash may be coming, probably influenced by all the doomsayers on the internet, like the Michael Burrys and such. So I'm just trying to deploy all the cash I have.
Yeah, I'm similar. I have get paid the same day every month, and I try and invest within that week. So
I would recommend doing something like Alan does, who was one time on the podcast. Just just buy every Monday. Prepare your buy orders on the Sunday or in the weekend, and just let it automatically buy on the Monday.
Yeah,
I think you take all the emotion out of it, and it has been doing him really well in the long term.
Yeah. Tim has asked us a question about cash flow. How many quarters or years of declining cash flows do you wait before finally pulling the plug on a company?
Yeah, so maybe some context. Tim was bringing up this on Facebook, because on Facebook there was a a picture shown like of a company life cycle, like in the early stages, then matures and then declines. And I said, I disagree with this narrative because I think in companies are more like in the S curve. You go to the early growth stage, you're investing heavily in the business, and then suddenly the cash flow, for instance, shoots up and then starts plateauing again. And that's typically where the company needs to reinvent itself. Yeah. So is that decline or is it the next S curve? That's always the tricky thing. Often we call them turnarounds. It can be Intel, which is very bad now, but it can also be Texas Instruments that's now investing a lot of cash flow into new factory capacity, right? So therefore, I would say it really depends on the company. But I can tell you where I've been doing this. I've been selling 3M. Yeah, I saw that the cash flow was struggling. I saw that the company was struggling. I saw that they couldn't really afford the dividend anymore. I saw the litigation issues. So that's when I pulled the plug on the company. Yeah, so that was my story. So, I would say slow compounders, companies that take years to build and build their free cash flow, they don't disappear overnight. Yeah. I would be more worried with evolution suddenly dropping heavily free cash flow in 2-3 quarters, and that may decide me to sell. But if I see it in Ahold, like 10% decline in free cash flow over the next 3 years, then I have more time horizon to think about it. So it's really about how quickly a company compounds. And I'm having a preference for slow compounders because they typically tend to really hard to compete with, because it takes a lot of capital investment to get there to the stage where they are.
Yeah, it's like looking at the numbers is only 70% of the story, but you have to look at the story of the company and why it's declining. And there may be certain reasons, and it might be temporary. So looking at numbers alone is not always going to give you the answer.
Yeah, but I think what Tim is looking for, he wanted to categorize his list of where companies are in the stage of the life cycle to kind of figure out, am I dealing here with a declining company or not? And should I therefore start selling? And what is, is there a bell ringing that says like, now's the optimum time to sell? And I think it doesn't exist. That's the difficulty with it. If we only knew, we could try, but that's why I focus on dividend safety, no matter the life cycle. For me, is the first question is the dividend safe?
Okay, we'll go to Tiago from Shade Research, and he has said that tobacco is up a lot this year. His own British American tobacco position is up 30% since he bought it 4 months ago. Would we sell it? And I own British American tobacco, and I wouldn't sell it, but it depends on what your investment thesis was. Did you buy it in the hope that it was going to increase in price by 10, 20, 30%, or did you buy it for the income and its high yield? For me, the investment case hasn't changed. They're still a high yielding company. They give me around a 9 or 10% dividend yield that I invest in other companies. And I've mentioned above, I've given up selling companies because I think they're overvalued. Yes, the price might go back down to where I bought them at, but I held them there for 2 years and it didn't bother me, so I'll still collect that. It's not until their story changes that my investment will change in them. So I'm not selling at this moment. Gedida has asked us about Louis Vuitton, LVMH. What are your thoughts on this after the share price dropped because of the pressures in China?
I think it's important to really look at China. China is probably the main growth driver for LVMH, like most dependency on there. I think Europe is also relatively strong, but it's important one. But other than that, yeah, the price is in a much better position than it was a while ago. Yeah, when it was around 900, now it's around 600. Dividend yield of 2.12%. So, I mean, I can't give an investment recommendation on this, but I think LVMH is there to stay. It's a solid company. Whether this is now the right time to buy, I think that's something personally there. But I think China in general, for many companies, is giving many companies a headache. China was for many, many companies the bull case over the last 10 years. Now there's much more dependency on it. So for many companies also now giving a headache. Yeah, that's what it is. And yeah, that's my thinking.
Yeah, it's a tough one. It's a tough one. They've lost nearly a third of their market cap in the space of 6 months. So obviously China has a huge bearing. So
Yeah, but maybe
and
it shouldn't have had that 1/3 of a market cap in the first
yeah,
place.
exactly. But China is the obvious weakness, and I mean, I struggle. That's where I struggle with companies that rely on China for that, because I don't know the landscape over there, and it can change in an instant.
Yeah,
Get a feel for it. So I don't know, but certainly from a price perspective, a yield perspective, um, LVMH is coming into a range which we would have said 8 months ago would have been attractive.
yeah,
Now, obviously, the China weakness is here, and for the share price to drop, you need weakness, you need something. It's a case of now what's your conviction in them,
yeah.
and where you go. I don't have that conviction. I think China is a big weakness, so we'll see.
It's a founder-led business. I'm very, very impressed with Bernard Arnault as
Of
a
course.
CEO.
Yeah.
He'll navigate this. I'm quite convinced.
Yeah. MMAX has mentioned that the market looks overvalued, so it's hard to find something to buy. In which sector do you see value right now?
I think consumer staples, like the defensive stocks. When I say defensive, I don't mean like the military stocks. I mean like consumer defensive. I see there mostly the value. And I
Yeah,
see it in my portfolio as well. Yeah, they have been going up lately. I think because of a rotation, but also real estate is still very attractively in some areas.
yeah, yeah. It's hard to categorize by sector. It's probably industry is probably a little bit easier,
Yeah,
but I pulled some statistics from Yahoo on sectors that have done well this year. They're all up, but the ones that are lagging are energy and industrials and consumer cyclical. They're lagging. They're low single digits. Well, you have technology up 15%, financial services up 15%. Real estate is up 11%. So maybe there's opportunities within the energy and some industrial and consumer cyclical markets. David Abraham has asked us about a ticker on the Stockholm Exchange called RVRC, which I think stands for Revolution Race. I don't know if you've ever heard of the company. I haven't before today, but it seems like that it is a active lifestyle clothing company. It's in Sweden, Germany, and Finland. It offers, I would say, outdoor activewear, which I'd expect from a Scandinavian company because it's cold. Looks like good quality, but I don't know much more about the company other than that. Looking at a pure numbers basis, it looks a little bit interesting. PE ratio is around 16. You've got a 5-year revenue CAGR of around 45%. Earnings kind of tracks revenue. It's a relatively new company. I think it's only 5 years old anyway. So it is a new company. It's a dividend yield of 2%, payout ratio of 40%, and a 3-year dividend CAGR of around 23% and very little debt. So look, from a numbers perspective, it looks interesting. It definitely is in like a high growth phase at the moment, but I always worry about these types of companies. I always do, because there's no moat there. It can be easy
yeah,
replicable, and you could have a German manufacturer, a UK manufacturer come in and make the same type of clothes and sell it to different markets and do just as
yeah.
well.
And
So
things go out of fashion quite
exactly,
quickly. Yeah,
exactly. So if you were to take the numbers on its own, I can see the appeal, but I I like to stay away from these types of companies.
yeah.
Um, Cadus has he highlighted that last week's episode with Pepper Shares with Lara was top shelf. Thank you for that. But he has a constant struggle. He likes so many companies with low dividend yields. So he spoke about Costco. He spoke about AOS, Smith, those types of companies. So do you get that feeling? And how on earth, in caps, how on earth do you cope with the temptation to buy those great companies?
Yeah, so for me, I mean, I don't know. I just have simple rules that I'm able to stick to. So anything below 2.75%, I just feel like, okay, my time will come. And
Yeah,
usually my time comes. It can take just 4 or 5 years, but usually my time comes.
I like it. I look at it, and it does depend really on your investment goals and theses. And sometimes these companies that are lower yielding, they've gone through higher growth, and you expect that higher growth to continue, or do you expect it to flatten out and so on?
Yeah, and that's what I typically don't. Because then you need to extrapolate the company at the same growth rate for the next 10 to 15 years. And I
Exactly.
always find that hard to predict. And, we often look at Visa, but how many more other companies like Visa can we count? Give me 10 of those.
Like I took AOS as an example and did a rough calculation and compared them to someone like VICI, right? So you have AOS, who has a low dividend yield. I think it's 1.5% or 1 point something percent, and the last 5-year dividend CAGR was 8%. Now, how long do I expect AOS to have an 8% dividend growth rate? VICI, on the other hand, have a 5% stamp yield. I took the last dividend hike, which was a couple of days ago, as 4%, and just used that. It would take AOS roughly 30 years with the same €10,000 investment to match my dividend income of VICI. Now, do I expect AOS to grow at 8% their dividend over 30 years? Probably not.
No.
Is it more realistic for VICI to grow their dividend at 4% over that time period? Probably. So yeah, that's what it boils down to for me. It
exactly.
Just depends
it's
on
the math.
Yeah. Alexandros has said, "Hey, European DJI, have you ever checked a small cap from the UK called Cakebox Holdings? Ticker symbol is CBOX."
No, but you're more into the space with Cracks PLC as well, so I'm curious to your thoughts.
No, I never heard of Cakebox, but as you can imagine, they sell cakes, fresh creams and cakes in the United Kingdom. It offers cakes for celebrations, designs, and seasonal cakes, as well as wedding cakes. Again, it's a similar story to what we had with Revolution Race above. It's relatively new, PE ratio of around 15, 16, 70% 5-year revenue CAGR. Earnings is slightly lower, 8 9%. There's a high dividend yield of 5.14 and a payout ratio of 77. And the 5-year dividend CAGR is around 20%. I don't like that high yield. Not that I don't like the high yield. I don't like the high payout ratio. 77% on a high yielding company, I don't like. In this type of company as well, where they're selling cakes. Now, I don't know about you, right? But I'm only prepared to spend a certain amount of money on cakes. So if they keep increasing prices, I just go somewhere else and I buy a cheaper cake. It bloody tastes the same. So again, this is a lot different than Greg's, I would say. And yeah, it looks like it's going through a high growth phase. Obviously, the dividend growth over the last 5 years was quite strong, but they did cut the dividend in 2020, which shows you with this type of company, it is very cyclical. They run into trouble, they'll cut the dividend. So looking at the numbers, I can see the appeal. Return on investment, like ROIC is 38%, but not for me. It's a company that's not for me. I couldn't do it. Wildebeest, what stock opportunities do you believe are worth looking at in the European and global property markets? It's quite hard. I always say the European property market is quite complex because the Irish market is different to the German market, which is different to Scandinavian market. It's quite difficult. And I do have a small position, but if I want to get into European and global property, I have an investment trust in the UK called TR Property. It is an investment trust, has a fund manager, has people that are experienced in this and know what they're talking about and know how to, how would you say, analyze all these different markets and roll that up. If you're not interested in owning an investment trust yourself, you can go onto their website, you can check their portfolio, you can check what they're buying, what they're selling, what they have the most of, and you can get a pretty good idea of what markets are doing well and where not, and make up your own mind. So it's probably a good resource for that, but I'm not experienced enough to give you an answer on what to look at, but I recommend checking out TR Property Investment Trust. Kevin has asked us about Evolution AB. He don't know if it's smart to buy the main listing on Stockholm with the currency exposure or on Tradegate in Europe, but this has higher spreads and lower volumes.
I would always go for the main listing. That's what I've been doing. So every stock that I buy, if I can, I buy them on the main listing because of the liquidity in the market there. Yeah, that's my main reason.
Yeah, I had the same thoughts when I was buying them. I bought them on the Stockholm Exchange. It's full disclosure, but I really think it depends on the amount that you're buying. If you're buying 10, 20, 30 shares, lower volume doesn't really matter. You're not contributing to the higher volume, so it's not a big issue. If you're buying a large amount of shares, definitely go on that exchange. But if you're really, 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 really worried about currency exposure, is it right to even invest in Evolution at all? Because you're exposed either way. Buy it in Europe in euros, or buy it on the Stockholm Exchange. The share price is going to reflect what you get.
But the same applies to the US dollar. I started investing in 2014, and I still remember that the dollar euro was 140 something.
Remember that? Yeah.
Imagine the amount of shares you could buy compared to today.
Yeah,
that went all the way to dollar parity, and now it's back at 111.
Yeah.
So if you zoom out, there's a lot of volatility even in the euro dollar trade. Yeah.
Okay. Source has asked us, what are your thoughts on, I definitely pronounced your name wrong, so I apologize for this.
Short verwoord.
Yeah. What are your thoughts on TRO? Price, ticker symbol TRO, is almost back below 100.
Same as actually as I always had. I mean, the company is having a spotless balance sheet, good dividend track record. Once you remain it like that, dividend can grow. Have to figure out a few things about, let's say, the impact of ETF investing or passive investing. They're working on that, but they have also strong lock-in in America with the, I guess, the 401k accounts. So, this is an example again of a slow compounder. You see it's coming from long. If you don't have the conviction, don't own it. For me, it fits nicely in my portfolio of having a financial, which is not a bank, as my thoughts about banks.
We'll keep moving. Dennis has asked us about ASML. It dropped to €140 on share price last week. Do you think that the share price now reflects the risk? Again, we have China and regulations.
I can't easily say that. I would need to dive a bit deeper into it. But generally, ASML is a strong moat. That's it.
Yeah, strong moat. I know it has high dividend growth, but again, with the current yield, stamp yield, it doesn't fit my investment thesis. So I don't want to waste my time on it until it starts getting towards.
Yeah, this is more for capital appreciation question. Yeah,
exactly. Is legal and general safe in your opinion? Asked Adrian.
In my opinion, yes, but I understand why, because the share price kept on dropping again. The yield is around 10%, I believe. So that's typically the red flag signal, right? Yeah. In my opinion, just insurance company in Europe are I don't know what it is, but they all yield highly, and I don't know what the market sees that I don't see. But for me, it's been always an opportunity to buy. I mean, I'm maxed out on legal in general, so I won't buy anymore. But yeah.
Andreas has said, for the Polish people out there, what is the deal with Ambria? It's going downhill, but not much info on it. Seems a little bit attractive.
So Ambra has been really going down in share price, and I was looking at it the other day as well. Like, should I buy more? Is this the opportunity to buy more? But I haven't gone deep enough into it because the information is mostly in Polish, so it takes me a little bit more effort to translate it. So I can't answer the question if there's something specifically going on, but it may be this in the same line of thought that we've been discussing today about Carlsberg, but also about Diageo. Maybe there are some consumer preferences changing that people are afraid of, and they are afraid that it will hit the long-term sales and opportunity of the company. But generally, I'm not selling it. If that's what people may be thinking, I'm just holding it, a small part of my position. And I don't sell easily on the news. Yeah, there's not a litigation going on as far as I know. So let's check the earnings reports.
Yeah. And three more then quickly before we finish up. Humberto has asked us about a company called Aker BP. What are your thoughts?
Yeah, so Aker BP, and then they also think about comparing it to Equinor. So Equinor is an oil and gas company, right? Like Shell, Total Energies. But Aker BP is a contracting firm, so they do this engineering, procurement, and construction. So it is actually a supplier, let's call it like that, in the value chain towards companies like Equinor and Shell. So Aker BP has always been a very solid company, specifically in Norway, right? But I think it is like it's a typical company that if Shell or Equinor sneezes, then they get a cold. So if you compare it to the oil and gas majors, I think they're always better positioned because they define the market and how the market looks like earlier than the Akers or the Technips of this world.
Okay. Adam has asked about your thoughts on Rio Tinto.
Yeah, very cyclical. So you need to understand where the commodity is in the cycle, and if you believe then that it is attractive, then yeah, definitely consider buying it. But I don't like the terms like cheap.
Yeah. I assume it's after dropping in share price, but I don't know where it is in its cycle.
So you buy Rio Tinto. What is important, same with BHP, try to find out what the baseline dividend is over the decade. Yeah. So taking the bottom of cycle into consideration, look back at 2016, for instance, and then consider the rest as all as special dividends. That's how I would recommend looking at it.
Yeah, just quickly check the share price. I think it has a little bit to drop to get to the undervalue compared to its cyclical history.
Yeah.
Philip, then last question. Philip has asked us about Microsoft. Already a buy?
Well, that last question we can't answer. We can't give advice here. Yeah. Even legally not allowed. But the question is I think, guys, we sound like a broken record. We're really sorry, but is the yield justifying at the moment growth? That's what we look at it. Is the dividend safe? In my opinion, definitely. Yeah. If the company continues to grow like this, and they are the example of the Amazon flywheel that's fully spinning. Yeah. But it's for me more a question not about dividend growth if you want to initiate a position, but more for total return in general. And for me, it is in that space now, Microsoft. And if it comes back into the picture at a 2.7% dividend yield or something like that, then I think the question is totally different to a dividend growth investor.
Yeah, 100%. 0.75% starting yield is, I would struggle.
Yeah.
It would go into a different part of a portfolio for me. It's not a dividend growth stock at that stage.
Yeah. Well, this is a growth stock if you own it already, like me. But yeah, I get your point.
Yeah. Nice one. So that is the last question. We had two more questions as well, but there are companies we're not overly familiar with, which would take a bit of time to look at. So we might look at them for the next episode. But again, thanks for all your questions. We tried to get through them as quickly as we can. We had a lot this week. And we hope you enjoyed our 4 European picks. European DJI, thank you as always. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.